or good afternoon, depending on what side of the country you're joining us from. Thank you for joining us today. We're really excited to have our wrap-up webinar of the year, our last one, very important one, not least important, but very important one, and last of the year. Hope everyone's having a great holiday season so far. We're excited to talk a little bit today about the state of the industry, bank and credit union transactions, and a little bit of our forecast for 2024 and where transactions are. As we go to the next page here, just want to go through a little bit of housekeeping before we kick stuff off. Charlie McQueen, President of McQueen Financial Advisors. I'm excited here. My co-presenter is Dan Martin, who runs our valuation business. Our other two components of our business, other two legs, are our investment advisory business and also our asset liability management business. Our ALM business does also include CECL. So really excited that we've got a bunch of different areas. But Dan, thank you for joining me today.
Yeah, thanks for having me. Happy to hopefully share some useful insights to all of our attendees.
Yeah, definitely looking forward to that. So as we go forward from here, just to remind everyone that we are recording today's webinar. If you'd like to get a copy of it, please reach out to your McQueen Financial Advisor, and they'll happily share a copy of it. It'll also be on our YouTube channel and our website too, so feel free. Also, if you have a question, please click on the Q&A button. It should be at the bottom of your screen, and we will either answer the questions while going through or at the end, depending at the appropriateness of the timing. So with that, we'll kick off. And as we go forward here, one of the things we need to start with is talking a little bit about that economic situation and what's going on. From there, we're going to talk about some big picture industry stuff, get into bank M&A and credit union merger activity and credit union bank purchases. So very, very pointed topic. We don't do a lot of economic presentations in our presentations anymore due to requests. We do have our economic updates. But when looking at what's happening in the transaction space, there's a lot of things in the economy that are actually causing it to be as slow as it is. If we think about this, we've had obviously a big rise up in interest rates. We've had the Fed raise rates dramatically. And obviously the Fed's been doing that to stop inflation, break inflation, depending on whatever term you'd like to use. What that's also done is it created substantial unrealized losses on investment portfolios and substantial unrealized losses in loan portfolios. And when marking things to market, as obviously we have to do in mergers or acquisitions, that has a big negative effect to capital and it makes things a bit difficult. So we definitely have seen this slowdown. And so thinking about what's happened here, as you can see, inflation, we have obviously it's come up dramatically from where we were in the 2% range back in 2019 and 2020 and before. But as the Fed saw this happen, and we've seen the core inflation, get pretty darn high up in the, 5s and 6s, and now we're getting down to 3.68 and 4, depending on which version you like to look at. But the rate of change is starting to accelerate, where inflation is coming down even a little bit faster, as you can see in the kind of the purple shaded box versus the green shaded box there. So inflation's coming down, a direct result of the Fed raising rates. And remember, the Federal Reserve raises rates to slow an economy. So with that, inflation is starting to slow. As we go to the next slide, the other thing, and remember, the Fed has this dual mandate. It's price stability and full employment. So they're struggling with price stability, and that's, again, why rates have gone up to slow economic activity to stop price increases. Although inflation still is here, we're still going up in cost, but just at a slower pace. They really want to get that down to 2% a year. But here we are with employment. We are at full employment. So the Fed is doing good on one of its mandates here. And since we're sitting in Michigan, our awesome office in Clawson, Michigan, we're 3.9% unemployment. Nationwide is also 3.9% unemployment. So definitely very low unemployment situation, a little bit better, actually, some data that came out a couple of days ago. But things are definitely looking good.
Yeah, I think one thing I'd add here, Charlie, with the low unemployment from the transaction lens, this can incentivize people to look at transactions, not just for the economic piece of it, or growing as an organization, but really to acquire a lot of talent. You think low unemployment rate, harder to get talented people to join your organization. Some people have looked at transactions to really kind of try and take advantage of that piece.
Yeah, that is a way to get it and find good people. It's been difficult, but the Fed's going to be pretty happy with this remaining where it is today, and hopefully it stays here. Now, go to the next slide. This is really, I think, something everyone in our industry really understands. This is M2, money supply, the amount of money in the system. The back lines, the gray shaded lines in the background, those are recessions. And so as you see, what we had starting to happen really in the 2008-9, when the government really started to throw money at problems. That was the beginning. They threw a lot of money at the recession there. We thought that was a huge number with the housing crisis, but they went way out of their way and completely overdid it in 2020 with a pandemic. Record crazy amounts of money got thrown out there that really increased money supply substantially, and the result was inflation. And so a lot of inflation we're having is a result of the money supply going up as much as it did. Now, one of the things you're going to see on this chart is we've never seen money supply come down in any meaningful way. We are seeing money supply come down dramatically, which has been making concerns for deposits. And that's one of the things people get very nervous about today is deposits and deposit generation. And so we're going to talk also about branch closings too, which will be interesting here as we go forward. But lots of money supply is going away. With that, one thing to think about here is we do have an aging population in the United States and a lot of changes taking place. I always love this graph. The right side, it falls off, the left side, it fills in. But what we'll also see is that there's been a number of years that we had some big numbers, and the baby boomers, which is already sloping down there, had some really, really big numbers. Millennials had a whole bunch of big numbers also, but the small group was Gen X. Gen X was really kind of a sandwich generation there as you look, and there was a small number of people that came in. And so what we're seeing here is a lack of people. And this is one of the things where I think the Fed's going to be able to survive and not have unemployment go up dramatically because there just aren't enough people in that kind of 35 to 55-year-old range right now. And so that's definitely bringing up millennials faster, and it's causing baby boomers to stick around a little bit longer. But as we go to the next slide here, you'll see what we're talking about is we're just missing a lot of people. Historically, when we've had situations like this, we've had good immigration policies in our country, and we've had a lot of immigration. Unfortunately, we have bad immigration policies. If we're letting people in, let's give them the ability to work. And I think that's what I'll come down to. I don't want to touch that hot potato of an issue, but I definitely would like to see some good immigration to help fill in this number. But this is going to keep things difficult from an employment standpoint for quite some time. So with that, a couple other things just to quickly hit on. Really interesting, Dan, here, the Manheim Used Vehicle Index, we're definitely seeing values come down. Why we bring this up here, it's something to think about that may be an indicator of higher losses, higher credit losses. And we are seeing car losses pop up. We are seeing credit card delinquencies come up. And effectively, things got bid up way too high. We saw a little bit of overreaction, supply and demand issue based, and now things are coming back. Now, if we go to the next slide, this is interesting here, is a big part of what causes, again, that valuation we talked about early on about loans and investments. The 10-year Treasury is a really good indicator of this, and 10-year Treasury also is going to be a big indicator of mortgage rates. We have skyrocketed the 10-year Treasury down from 50 basis points from 2020 there, January, February, hit all the way up to 5% just a couple weeks ago, and we've now come shockingly back down about 80 basis points. So some big changes there, Dan. And by the way, Dan, are you starting to see some changes to valuations because of 10-year Treasury coming down as much as it has?
Yeah, I think just looking at transactions we've taken part of in the last, couple of weeks, we've seen some big improvement on the discount on loans, and as most people have seen in their bond portfolio, and then also just kind of the premiums that people are willing to pay. Obviously, there's a direct correlation here between discount rate applied on things you purchase or the required return you need, and so a lot of this is tied directly to that 10-year Treasury yield.
Yeah, definitely a lot of pieces changing. Don't know if we'll continue this way. It's been a very big move very quickly with really, and as we go to the next slide, the market really changing its expectations of the Fed. This chart's been all over the place in the last 2 days. We had a Fed meeting yesterday. Fed came out and said they're going to leave rates unchanged. A whole bunch of speculation came into the market of when does the Fed start lowering rates. The dot plot shows 75 basis points. Now, I'll tell you, their dot plot has been wrong over and over again. This is the Fed funds futures. The Fed funds futures are showing us at the end of 2024, we're at 4.5% is the high end of Fed funds rate, or a whole 100 basis points lower today. This also shows that the The first cut is going to happen in May of 24. I personally think as a company, we believe it's a little closer to July or September. But definitely the market is really starting to expect that the Fed sees rates coming down here. So a lot of changes taking place very quickly. Don't know if this is going to be correct. We expect not to be as correct, but here you can see our predictions here. If we look forward again, June of 24, we do expect that we'll see the Fed lower rates 25 basis points and then continue from there. A big component of this is the consumer price index needs to continue coming down. If you really want to do a good job of forecasting interest rates and forecasting the Fed, just look purely at where inflation is. If inflation continues to come down towards 2%, we're going to see the Fed eventually start to lower the Fed funds rate. If we don't see inflation come down, they're going to leave it where it is. And if we see inflation go up, we're going to see the Fed raise rates. So a lot to be seen here, a lot of conversations. I think as we think about transactions and move to the future, I would expect and plan on rates being unchanged. And in the end, we won't be much different from that either way at the end of the next year. Maybe a little down, but just mostly unchanged. So Dan, let me hand it back to you to talk a little bit about institutions and the numbers.
Yeah, I appreciate that, Charlie. I think that was a kind of a good frame of where we're at in the economy, how that's going to affect our transactions. Now, I kind of want to touch on some of the industry highlights or things we're experiencing as a whole and kind of how that affects future transactions over the next years. So first piece, just looking from a banking perspective, the number of banks, we've been in this multi-decade decline of number of institutions. Again, this is something I expect to continue to occur. Maybe not in an accelerating pace as we kind of get less and more consolidations within our existing institutions, but definitely an activity that continues to happen. And as mentioned earlier, what makes this difficult? Well, certainly banks that are looking to merge with other banks from a purchase accounting standpoint are going to have a difficult time, with stock prices down, facilitating that type of deal, but also from a purchase accounting standpoint on loans and investments, right? So you have to be able to handle those discounts on those marks to keep a deal alive. I think, going along with the consolidation we're seeing, we're really not seeing any new bank charters. You look at the early 2000s, we had 100+ new banks being put together a year. And, now we had 14 and 22. That's a relatively small number. And I know from a use of capital standpoint, it's become more expensive to start a new bank today. And I know, Charlie, you have some experience with that.
Yeah, it's interesting, Dan, here. I just wonder if the regulators out there realize they're working themselves out of a job by not approving more banks or encouraging more banks to be started. That's something important. If we look at what happened, there was obviously some activities that happened in 2009 and then a change of leadership in our country that just didn't want more banks. And I hope someday everyone wakes up and realizes it's good to have more banks. It's good to have community banks and see that change here. But it is going to put some scarcity value in place, Dan, and the number of transactions will be down, but we'll still see the number of institutions continue to come down. Unfortunately, probably too quick for consumers goods.
Yeah, thank you. I think, pointing out the credit union piece of this as well, we're seeing very similar trends, right? I think when we look at or think of the banking sector historically, community banks tend to have a slightly larger size than credit unions. I want to say half of the remaining 4,700 credit unions in the US are under $50 million in assets. So I expect over the next decade, a lot of that we're going to see some continued consolidation, as it's really hard to operate as a small institution today. So again, similar trends we're seeing. I know, Charlie, you've probably seen this quite a bit as well.
Yeah, it's interesting, Dan. People say how hard it is to start a credit union. We only see one start every couple of years at most now. And I go back, there was 10,000 credit unions. So somehow they were able to start them at one day. And so I just, again, think regulators should really rethink their decisioning on how hard they're making to start to continue to keep the trend going and keep the industry going. But yeah, definitely, Dan, there's a lot of consolidation that is going to continue to happen. It's hard to survive with $50 million of assets.
Right. So, understanding kind of where we're heading from a trend perspective, if we look at kind of what has taken place this year. So we've had a lot of interesting events. We had our SVB collapse, that lowered the price of bank equities. I think we're down about 20% this year. In turn, that really cut off a lot of bank to bank transactions, right? Because you can't use your stock to help facilitate that if your stock is not trading at a high enough level. Looking kind of at the cross industry transactions, credit union banks, this is still relatively new novelty. I mean, we're seeing consistent levels with years prior. Probably expect to see consistent levels year over year, possibly a little increase as, being a cash buyer has a lot of value in today's environment. Back on the liquidity side, deposits or the lack of liquidity, that has fueled a little bit of demand in the transaction space. But again, with those purchase accounting adjustments, we're still operating in a fairly tough environment. Is that fair to say?
Yeah, I think, Dan, it's a really interesting point here. When we see equity value stocks trading less than book value, it makes it very tough. You become very dilutive. And so we'll definitely have to see some of these valuations regain. And I think we will. I mean, we're going to see some rallies in the stock market. We hit an all-time high yesterday, actually. So we're definitely seeing things change a bit. Great points.
Yeah, I think looking, kind of just specifically at our credit union merger folks, we mentioned there's 2,000 credit unions under $50 million. We have not seen a huge, bump up in credit union merger activity. Trends we've noticed here at McQueen, there's been a little more conversation along the lines of distressed credit unions looking or being recommended to merge away. I think that's something that'll probably continue as we kind of operate in this liquidity crunch. That might change a little bit as rates cut next year. But I think we're still in a relatively tough operating environment from a merger standpoint.
Yeah, Dan, I do think that it has to be a good strategic fit given the valuations today. And again, want to be very careful to make sure capital is not getting too degraded by the mark-to-market activities. And some secondary capital is helping, and that's a spot we've seen some people do. Some clients go out and get secondary capital to help build up that capital to do a transaction or to do a merger.
Yeah, I think an underrated thing that a lot of people don't necessarily always consider either is when two credit unions merge, you may have in your head that you want to have one credit union as the survivor, but really you should be looking at it both ways, right? So I think we've seen, potentially some significant financial advantage with going one way or the other for, who gets marked to market in that process. But I don't think that everyone engaging in this activity necessarily looks at that, but I think they should. So, as mentioned, looking at bank deals, 2022, we ended at a market average or median of 1.3 times tangible book value. So that means if I have $10 million of equity, I'm getting paid $15.3 million for that equity. Um, because of this environment, that multiple average has dropped down to 1.24 times tangible book. So we've seen a pretty big drop in prices and premiums people are willing to pay in today's market. You look at 2019, what we saw in Q4, we were at 161 basis points. In 2020, that dropped to 134. So seeing a similar drop to 2020, I expect as people get more comfortable operating in this environment, with a crunching margin, increasing cost of funds, they get a little more comfort in what they can handle from a acquisition standpoint, and really probably the prices they're willing to pay.
It's interesting, Dan. People see these stats and say, "Hey, well, I paid 1.8 times book or 1.7." And you have to be careful. Sometimes you get some really big deals in the bank spots that are mergers of equals. Then they're doing book value type swap numbers, which really drag these down. So sometimes the median can throw you off a little bit. And that's why when looking at trying to value something, we'll actually look at individual transactions and look at the uniqueness of them and find values there. But it is a good indicator. It is a good indicator that it's tougher to make deals work right now, which directly results to the number of transactions taking place. So really, really good information.
Yeah, I think I appreciate that because, one other thing that you really should consider when pricing is, it's what makes sense for your institution, right? The market can price things out however they want, and there's going to be certain reasons that people are going to be willing to pay more or less for a certain institution. But ultimately, you should really only pay for what makes sense for you, and based on what you can do with it. So. From there, we touched on this credit union bank purchase activity at 10 through where we're at today. This is as of August 31st. I think we've had a couple announced since then. I expect probably a couple more deals the end of this year. So, we might hit that 14, 15, 16 number, probably something similar going into next year as well. Charlie, what are your thoughts on that?
Yeah, Dan, I love the question. It makes sense that dollar amount is down, the total assets, and it'll come up a little bit by year end. But again, this whole makes sense that things are down because of the valuation things are happening. But there is a lot of conversations, and I think we're going to touch on obviously branching here in a minute. It's so difficult to actually get someone to come in and join a credit union or sign up to be a customer of a bank. To get people in the door is hard. So a lot of times it's really M&A is a easier way of obtaining new customers or new members. So I do agree with you. I think the numbers are going to be up a little bit higher at year end, and then next year I expect to be about the same. It's definitely going to be tough sledding once again, but remember, time fixes a lot of things. As time goes by and we get closer to the maturity date of loans, and if rates keep coming down, it's really going to improve the valuation activity, which then will most likely boost up some transactions.
Yeah, thank you for that, Charlie. So here, really, just kind of showing the spread or and lack thereof on bank deals this year. You see a concentration kind of in the Midwest. This is relatively expected because if you think about the number of institutions across the country and where they're concentrated, this is going to be kind of our biggest concentrations. You think Wisconsin, Illinois, Ohio, Michigan have a significant number of institutions, and so that's kind of where I expect it. I'm a little surprised. Not a ton of activity on the West Coast, not a ton of activity on the East Coast. I think that's where we see some larger transactions, so you might see fewer over the course of a year anyway. But yeah, so this is interesting. Now, when we look at credit union bank specific transactions on our next slide here, we can see some very obvious concentrations. Again, back to the Midwest, with the most number of transactions, Illinois, for example, very easy state to work with when you talk about these deals. So you can see they're kind of leading there in the Midwest with 12 transactions. Then you look to the South, Alabama, Georgia, Florida. Again, some of our northern states, you have some snowbirds, so you have some customer relationships already down there. So it makes a lot of sense to put some locations out there to serve your members. I think this year we may see a little bit more expansion geographically, particularly on the West Coast, maybe a couple on the East Coast. And then, Charlie, I don't know if you saw the recent legal news out of Tennessee where they now allow credit union bank deals to take place.
Yeah, it's interesting news that came out. There was a long battle that was fought there. But I do think, yeah, I agree with you. The geographic expansion is going to continue. But also remember, a number of these states were spots where there's popular inflows of population. Georgia, Florida, huge inflows of population. But also there's a number of states that were really late to the interstate banking laws. Illinois, for example, was, I think, the last to end interstate bank branching laws, and so they were all by county. So just a lot of small banks in Illinois that are still getting consolidated, and a couple other states too, but that's just one as a good example. So I do agree with you. I think it's going to continue. It'll be a bit more robust, spread out across the country, but we're definitely going to see transactions continue.
So thank you for that, Charlie. I think another trend that we're seeing, this is based on FDIC data, is really just the net closings of branches. We talked a lot about in 2020, kind of people shifting their strategy from an operations standpoint and really what you need from a branch footprint to within the last couple of years, you start looking at profitability of some of your locations to determine, does it make sense to keep these open? We've had a number of clients go through that process with us. You look at Maryland here, net closings, 17 This is just the month of August here. Connecticut, you had 10 closings. So really not a ton of openings. We just mentioned Illinois, and that conveniently is leading the pack here on openings. But what are you seeing as far as branch structure or strategy from some of our clients?
Dan, the easy answer is the larger institutions are over branched, and you had some big mergers that took place and the regional mergers, and they have too many branches. So we're going to continue to see closing down. I also know that I use my institutions very differently than I used to. I have the Charlie McQueen branch, which would be my cell phone sitting here, and I use that for checks and anything I need to do except for cash. So my utilization, like everyone else's utilizations, change. So I do expect we're to continue to see the number of branches come down. Also, something we're seeing a lot more of is hours, different hours by branch. We're seeing branches open just 3-4 hours a day. So I do think the model has changed, and it's something we should all be thinking about every day, that we don't have to have the same footprint. We can modify that footprint and even move around the corner, but closing branches is a great cost savings activity.
Yeah, I think when you think about cost savings activity, you really want to consider, margin and where we're at today. When we think about acquisitions, a lot of what we're looking at, or a lot of incentive is really in improvement to earnings, right? And so in the last year, we kind of look at what has happened from a margin standpoint. You see for the last, 22, we were at 60 basis points here, 23, we're at 60 basis points here. Projecting out, we're at 70 basis points from an ROA target. Definitely a tough environment with the cost of funds today. So Charlie, if you had any thoughts on kind of ideal ROA target, or really how we can help our clients get there.
I love this graph. 1% ROA to me is a minimum ROA that I want to get at all times. But you have to remember, like growth, it's difficult to get growth today because of the market we're in. But if you look at growth over the past 5 years, if you just take that growth and average it over 5 years, we've had 5 tremendous years in the industry. Most of our clients have exceeded their growth expectations if you roll the last 5 years together. Now, if you look at just last year alone, it's a bad year for growth, or 2023, it's just a bad year for growth. 2024 is going to be a difficult year for growth also, because of people spending more money than they have, money being pulled out of the system, money supply shrinking. We're doing quantitative tightening. The Fed's consistently pulling money out of the system right now. So it's going to be difficult. But I look at ROA the same way. When I think about this, if I look back over the last 5 years, I've had a really good ROA. If I look at this year, it's going to be tough because that cost of funds, as you mentioned, Dan, is really coming up and hurting margins. Now, I also worry a little bit about credit losses this next couple of years and how that may cause ROAs to get a little bit tougher. Remember, CECL, it's new for everyone. Unemployment's a big component of CECL. So if we do see unemployment come up, it's really going to hurt that number, which then will hurt our ROA. So I'd love to see everyone target 1. Some days we should be above 1. Some days we should be below 1. But it's going to be tough right now, and I expect the industry average to be a little bit lower than that this next couple of years, Dan.
Yeah, thanks. I think one thing that people should realize too is when we're looking at transactions, typically our target for earnings improvement on the institution that's either being merged in or purchased is going to be somewhere between 50 and 100 basis points. So inherently, when you engage in this activity, you're going to improve earnings, right? You're not going to have a lot of duplicate costs, right? You only need one core system, you only need one auditor, that sort of thing. So there is some improvement you could make through transaction-based activity. I think another interesting thing here is kind of just looking at size of institutions. Here the largest institutions have the lowest margin. I think some of that can be made up for, based on the volume they're doing. But I know when we look at deposits repricing and the pace of repricing those deposits, it's always the largest institutions that are leading the way, kind of getting ahead and taking as much market share as possible. Charlie, what have you seen from a profitability standpoint as it relates to kind of institution size?
Yeah, Dan, it's very correlated. At least from a margin standpoint, it's very correlated. You don't need a duplication of a lot of positions, and you can then therefore run at a lower margin to make good earnings. And so size does help a lot in the industry. I know there's been lots of debates what's the smallest institution can be, and I never want to wade in those waters because I think anyone can survive, but it is easier. You can have lower loan rates and higher deposit rates at a larger institution, which is really one of the, unfortunately, the key ways that people compete is really a yield or pricing based competition. So definitely, earnings then do get modified based off of other things, non-interest income. Different institutions may have different types of non-interest income that will put their earnings a little bit out of the size guide range. But just from a margin standpoint, it's the bigger institutions definitely do much better.
Yeah, I appreciate that because I think that goes kind of hand in hand with this graph here. Just looking at operational efficiency, right? So at the bottom here, we're looking at assets under 50 million on our far left are typically operating at a roughly 90% efficiency ratio. You start going down this list and you really start to pick up some nice synergies with size. And again, this is part of the incentive for looking at transactions is as you grow, your ability to gain economies of scale enhances. So, you look at the group of 250 to $500 million in assets, we're at 68% efficiency. You get down to above 10 billion and that drops down to 55%. So profitability as you increase in size becomes easier.
Dan, this is just one of my favorite charts. It really does explain the importance. It's not everything. I mean, there's ways you can be much better efficiency ratio at a small size. There's ways you can be worse at a big size, but just in the big picture, thinking about how you're managing it does make a difference, and it really outlines it very nicely.
So I think another piece that becomes very important in this process is kind of our capital and what's happened to it, especially in a transaction space, right? So we've seen some big dips there in 2022 on equity growth. A lot of that being from our bond portfolios and having those discounts flow through. You noted earlier a little bit of improvement over the last 30 days or so as that 10-year has come down. But really important to maintain and grow capital to kind of facilitate any type of transaction opportunity.
Yeah, Dan, you look at this here. This is, I think, a great example again why transaction activity has slowed dramatically. We saw, 10% reduction of capital. We had the skyrocketing interest rates, all sorts of things popping along and issues there. A lot of people actually were also selling securities and taking losses along the way. So definitely some changes. And so this is part of that rebound why we think transactions are going to be at the same level next year, maybe even a little higher. It's based off of what happens with interest rates here and what has happened and how capital grows. Without capital, you can't do anything. So this is one of those key components to keep a close eye on.
Yeah, so along those same lines, when looking at capital, if you think about if a credit union's purchasing a bank, now this is kind of the only situation in which this applies. It's a very capital dilutive activity, right? Because you're picking up X number of assets, but you don't actually add any equity. So it inherently reduces your capital. Now, some of the things we've been able to do to mitigate that, you could look at subordinated debt if you start to get into capital ratios that are either below policy or below where your regulator wants to see. The other thing in transactions to be careful of, and this really applies only to larger credit unions that are engaging in the risk-based capital calculation, whether you're opting into CULR or if you still follow the risk-based capital rules, there are some important factors to consider there as you go and look at every transaction.
Dan, one of the things that just to highlight in this chart too, and I appreciate those comments, we are beginning to see that core capital ratio of banks come back up. Obviously took some pretty big hits in September of 20 and 21, and as we into 2022 and 2023, it is definitely coming up in the right direction. Again, once that gets back up into the tens, a little over 10, I think that's be another indication that we'll see some spurring of activity again.
Yeah, thank you for that, Charlie. So just to highlight kind of the pieces here on capital, again, a lot of people taking negative hits to their capital because of the unrealized losses on the bond portfolio. What are some of the issues with this? We have borrowing limitations, CECL adjustments, and really there can be a negative perception associated with that. Although they're unrealized losses, seeing you take hits on your equity doesn't make anybody feel good. So really some key takeaways is really to have a plan in place to kind of mitigate this as best you can. You can use secondary capital, raise capital, or if you expect kind of a decrease in capital levels here, you can borrow ahead of time so that you're not under a crunch in the time of need.
So Dan, if you go back just for one quick second there, I think it's really thinking about that plan ahead. I can't really stress this enough. If you want to merge people in, or if you want to remain independent, making sure you're planning, where do I want my capital to be and why, and what am I going to do to get in place? And also, what are the types of risks I'm taking? Do I have risks that maybe not looking good in the next couple of years? Maybe I put too many office building loans on my books and I'm worried about the value of office buildings, and should I go out and get secondary capital today, or should I go out and do a preferred stock offering as a bank or a capital raise? Lots of different things you can do to plan ahead, and looking and knowing your balance sheet, you can make the best decisions. But also, again, if you want to remain independent, you don't want to have to merge, then building capital and building earnings. And if you want to acquire other institutions and still grow, but it's that really growing that earning stream, growing that capital stream is so important. So taking the time to plan and not be surprised is one of the most important things. And so I love your comments here, so thank you for adding them here.
Yeah, I appreciate that commentary as well. I do want to key in on one item you hit on regarding secondary capital subordinated debt. This is something that really most institutions should at least have in their back pocket. So if we think about the process to get approval for subordinated debt, you can go out, get approved for it, not issue it. So you're not really bearing the cost of issuing that debt. But then once you have that approval, that's good for 2 years. So you can effectively have that dry powder in your pocket for up to 2 years without issuing. So I think that's probably something a lot more institutions should really be considering. All right, now if we think about kind of our goals in M&A, I want to go through kind of what do we typically look for, right? So why are we engaging in this activity? So here's just kind of a list. We talked about economies of scale. We talked about, kind of that lending or picking up good lenders from an employment standpoint, expanding to new geographic areas, really just growing the institution as a whole. Some of the other reasons you might do this, you may want to limit people from having access to your membership base, right? So if there's a in-market opportunity, you may be wanting to be more aggressive from a purchase standpoint to prevent other people from having access to your membership. So a lot of different reasons, really, when looking at any transaction, a lot of these should be considered and understood kind of going into that.
Dan, I think that's a really interesting comment. Be protective, and a little defensive play by, merging someone in or acquiring someone that's in your neighborhood so someone else doesn't come in and get it is a really smart thing. I do think we've seen a number of times too, is someone that maybe has an expertise in one type of lending, but is not good at another type of lending, to acquire that expertise, which really goes back to those people comments you made on one of the first couple of slides we talked about today. So great information here.
Now, of course, it's not all roses and rainbows. Certainly, a transaction can be a difficult activity to undertake. I think first off, you got to have or be willing to have the capacity internally to take it on. Right? There's a lot of work that goes from an integration standpoint. But if you can make that successful, you do it one time, you prepare your team, you gain that knowledge and process internally. It really sets you up for future success and future opportunities. A couple of things really to consider: state versus federal charter, if there's any field of membership issues. We talk about retention of key employees, right? So if you're going to merge somebody in or acquire somebody for that talent, it's imperative to lock them up and make sure we have a level of commitment from those employees. And ultimately, management and culture fit, right? So the same size institutions can operate very differently. So ensuring you have a understanding of, how things are done, expectations, how they're set, can really go a long way in ensuring a successful transaction. So we touched on this a little bit. So if you're looking at this type of activity, what should you really do? Obviously position yourself to acquire. We want to enhance earnings. We want to set up our balance sheet and our income statement as best as we possibly can, right? It gives us the most optionality. A couple other things, you know, you want to have a general strategy, right? If you're considering this, you don't want to go in blind. You know, it's something we can certainly help you with there. But Charlie, what else are you seeing institutions do to really set themselves up to engage or at least consider this type of activity?
You know, Dan, it's really there's a list of things, but it's really getting ready and for profitability and growing equity. And you know, looking at different ways, loan pricing, getting better at loan pricing, deposit opportunities, looking at borrowing activities versus just randomly raising rates, and being very thoughtful about the rate structure and really working on that margin. You know, this is a margin business we're in, and so making sure we get that margin the best we can at all times. And then from there is getting in the ways of fully utilizing the possibility of earnings we have. And you have down here employee benefit accounts, employee benefit pre-funding accounts, EBP accounts, and the credit union space. That's a way to maximize your earnings to get more dollars in there to help pay for those expenses. But really all that does is boost your ROA and boost equity. And so there's great things that you can do. And really there's a list of you know, we've got about 20 different things that our advisors talk to our clients about on a daily basis here to just make little singles and constant singles and growing earnings and growing equity. It's really important.
Thank you. I think one of the big things for me is, you know, willingness to get creative, right? So what does that mean? When you think about your earning stream, we talk about this margin-based business, right? Your yield on loans, your cost on deposits, what it costs to operate your business, and that margin, right? I tend to find non-interest income as an incredibly value add for any institution. So I look for ways, you know, what can we acquire? What businesses can we grow in that would provide additional non-interest income? I think the one of the most common ones that comes to mind is really looking at the mortgage business, right? So mortgage companies, obviously right now, definitely not a hot time to get into that, given where volume has been. You know, we're in a refi lull at the moment. But I think when we talk about rate cuts in the next coming years, you know, potentially some pickup, they're probably not a bad place to be from a fee standpoint. And then we look at things like SBA lending, right? So some really nice fees associated with SBA lending that can add additional income as we grow our balance sheets. A couple other pieces here from a credit union standpoint, looking at credit union service organizations. That's a whole host of ancillary businesses that can be held under that structure that the credit union can either have full ownership of the QSO. You know, you can purchase stakes in these. This is a nice way to grow and expand your business. And then we kind of look at two other pieces that are really things you can offer your members, right? So insurance, being able to offer auto or home insurance as you're giving out loans, or really wealth management. You know, Charlie, I know you love to talk about going and sticking a broker in the lobby of your branches, right, and offering that service to members. Really, there's a whole host of additional growth opportunities to consider. But I think it all comes back to, you know, defining that strategy and really planning your business around the ability to take advantage of opportunities.
Yeah, Dan, I love this list here, and I think you know, kind of talking about in the reverse order that you did, wealth management is a great thing. If we look at the uncertainty we have today in the stock market sitting record highs, so those people, those clients of ours that are offering wealth management are getting really good earnings because the assets under management are just growing and the revenue is growing. Insurance, there is a massive upheaval in the insurance business taking place in this country right now. If you haven't had your car insurance come due, when it does, you're going to be shocked how much the costs are going up. The cost to fix cars is skyrocketing, so we're seeing insurance go up dramatically. And so there's going to be a lot of people shopping for new insurance. So I think it's a great time to look at that industry. You know, from there, you talk about mortgage companies, and it is, to me, there's some things that a consumer is going to do every day. Consumers are going to buy homes every day. Maybe not as many right now, maybe not refinance as much right now, but it will come back. It won't be a lull at all times. And sometimes getting into a business model when things are slow is easier than things are running really fast. So if you're not involved in a mortgage activity or have it, it's probably something smart to look at today. And then using all sorts of different activities here, all of these combined. You don't need all of them, but make sure you don't do just things that are move in the same direction. I want to make sure that during a rising interest rate environment, I'm getting good non-interest income. During a falling interest rate environment, I'm getting good non-interest income. So making sure you're looking at a combination of things and not being a one-trick pony is actually something really important here also. So great things here, Dan, and working on some of these growth opportunities really helps position you to be able to acquire, to be able to grow and do different things as you go forward.
Now, Charlie, it looks like we did have a question come in here asking what your thoughts are on institutions' ability to invest in fintech or crypto-related entities.
Oh, I love. We're going to crypto first because I just, I haven't been able to quote Charlie Munger in a couple days, and I think Charlie Munger, Warren Buffett's comment was, "It's absolutely stupid." I think that was his word choice. I struggle with crypto. I get it. So I think before I'd offer crypto, and I know there's some people out there doing it, and they're doing really well at it, but I would first make sure that I'm offering all of the standard services that people want first. And if you're already doing all these other things in this list and you want to get into crypto, why not? I think you're now giving more options. Um, I love fintech. And Dan, one of the things, we can talk about getting lunch, and is it a sandwich or you can look what kind of sandwich. Well, fintech, I look at it as kind of the same way. People use the term fintech just like I use the term sandwich. It could mean 1,000 different things. And so fintech isn't always fintech. It's just people call it fintech. Financial technology, really important. Are there things I want to invest in? Absolutely. But I also want to make sure that we really carefully think about and look at and see what it is. I see a lot of people investing in things that are not fintech. They're good old fashioned, cold calling type organizations, which is they're important, but they're not fintech. All right, Dan, we did get another question in here. Add this out here. How can we grow a new market if we're not putting in a physical branch? Oh God, I love that question.
Yeah, I think that's a great question. Without putting in a physical branch, I think there's a couple ways to do it, right? So the first way my brain goes towards is looking at lending, right? So how can we get loans potentially in a new market, or how can we generate deposits in a new market? So, you without putting in a branch in, maybe you have a loan production office, right? Or you have a remote lender that's working in any given market that may be able to pick up some sort of market share from the lending side of things. Charlie, any thoughts come to your mind?
Dan, I love being the second one to answer questions because you get a little bit more time to think about them. And I'm going to go down the obvious path. You should buy a branch from someone else. And I think that's actually one of the things we talked a little bit about branches opening and closing, but we've seen the number of people selling branches go down because people don't want to lose the liquidity today. But to get into a new market, to buy an existing branch from someone that has deposits, that's going to be the easiest. Buying an institution, another easy one out there that's in that market, but this is tough. We used to, the old day, and it would be build and they will come. We're going to go build a branch and people will flock to it. That is extremely difficult. People's habits of how they shop and where they go is so digital today. We're looking at some charts on where people meet each other, and by far it's digital channels. And how I interact with my financial institutions, by far it's digital channels. So digital marketing comes to mind, and having a good web presence and having good digital marketing. And then the last thing that I'll add here before I've taken this question way too far is billboards. Over and over again, our clients tell us that they get good results from billboards. Now, for clarity purposes, Dan or I do not own billboard companies or any billboards, so we're not self-promoting. But that's something where CPO say they get good responses from those also.
All right. I think that that wraps it up. Charlie, are you seeing any other questions here from the group?
Nope, I think that wraps it up, Dan. I think we're going to give everyone a couple minutes back in their lives to run to the bathroom before their next meetings, which is awesome. But really appreciate everyone being here and spending some time with us today. Dan, I appreciate you spending time with me and your entire team, doing amazing things and helping our clients achieve their goals. One of the key things to remember, there's a lot of ways to get to places, but the best way to get there is by having a good plan, knowing where you want to go, and then working on that plan to get there. So make sure you think, take some time, doing strategic actions like transactions, like mergers, A lot of people just jump into them. What I'd rather see you do is give us a call or sit down with your management team and do a good strategic plan. Think about where we want to go, what our goals are. And when you have really well-defined goals, you know where you want to go, it's much easier to quickly look at potential opportunities and pass on them or go forward on them versus really wasting a lot of valuable management time. So good planning is absolutely key. And Dan, you and your team are really good at that and always happy to help.
Yeah, I certainly appreciate that, Charlie, and appreciate everyone for joining us today. Um, happy to jump on a call with anyone here and talk about strategy. It's one of my favorite things to do. So look forward to hearing from everyone.
Well, thank you guys. Everyone enjoy the rest of your day. Thank you very much.